Nigeria's bond market traded on a slightly bullish note this week due to increased demand across board. Traders at UBA attribute the sentiments to the coupon inflow into the system. Chuka Wajuku, the head of fixed income trading at UBA, joins me now for a weekly wrap of the markets. Thank you so much for your time, Chuka. And tell me what's played out with those inflows coming in.
Okay, so we've seen a slight improvement in liquidity through the inflow, like you mentioned. We saw a coupon payment of 65 billion coming to the system, and also some maturities of Tbills yesterday. So that's kind of like eased the pressure on the liquidity. Another significant thing this week was the NTB auction, which was on Wednesday. We saw a significant increase in the rate from 7.443 to 8.5, and that has actually taken everybody by surprise. Yeah, we know there will be an uprise increase, but not this margin, which is good for the system.
All right, well, how's the market interpreting the second quarter GDP figures? We're seeing that come at 3.54%.
Yeah, the results, the figure just came out today. We've seen a growth from 3.1 in the previous quarter to 3.5, like you said. This is a positive development for the market. We bring in more confidence into the market, and then also we show that the Nigerian economy is growing. I think the analysts actually expected it to grow about 2.9, and then it's at 3.5, and that's a significant improvement.
Well, looking at the markets today, though, what drove sentiments today?
Yeah, the sentiment, like other week, has been on the liquidity. So what we saw in the market over the couple of days is that we've seen mixed reaction. Firstly, we've seen people trying to reinvest the coupon payment into the bond space, and so that obviously is a bullish sentiment. And then we've seen also bearish sentiment, people looking to sell, in order for them to create liquidity to carry out their different transactions. And that's on the T-bill side as well, because the T-bill has also witnessed a shock, like I said, the NTB auction. And going into the end of the week, into the end of the month, we will see a lot of activities follow this pattern.
Yeah, but do you think that we can see more bearish sentiments coming into next week for the T-bills?
That will depend on the liquidity, and next week is looking good because there will be FAC payments. So FAC comes in next week, and then the system is liquid. So we'll probably see a bit of a respite in terms of liquidity, and that will chart a course for the trading activity into next week and then end of the month.
But how would that liquidity also impact interbank rates?
Yeah, presently interbank rates for the past how many days have been trading around 15%, but yesterday and today, because of the liquidity, the respite in liquidity, we saw rates around between 14.5. So it's kind of like has helped, in terms of the rate, the high rate we've been seeing in the system. Another significant thing I need to mention is that next week is the end of the month, so we see a lot of bearish sentiment. People looking to not only create liquidity but also trying to realize profits for the end of the month. So that is also another factor that will affect trading next week.
Yeah, but when you look at the market, though, especially the third quarter, as it's about to wrap up now, what's the major trend you're seeing that's different from the first two quarters?
Okay, the major trend is that, firstly, we've seen that there's a direction, especially on the fixed income space. There's a direction of upward movement in yield. So we're very sure that, okay, this is the direction it's going. This wasn't so in the first and second quarter because we weren't too sure what the direction we go. And then, of course, we also look at the inflation results. We've seen inflation move from 16 levels to now 19.64 levels, and then probably might get to 20. And so this will also affect activities going into the third quarter and then till the end of the year.
Yeah, because when you look at that signaling from the central bank, especially it starts on how it's going to keep working to address the inflationary pressures here. What does this portend for more or less yields going forward?
Yeah, I will just quickly digress a little bit. So we look at the inflation as well. Also look at the most of the inflation parameters are actually being caused by exchange rates, and so as long as the exchange rate is a major factor, it will keep affecting inflation. Now, in terms of what the central bank is doing and how it can bring in confidence into the system, I think that they should just continue, meeting up demand, and then of course, things that has to do with treasury bills and bonds is not solely on the hand of the central bank, also DMO. So we should look at what DMO is also doing. The mandate of DMO is actually to borrow as cheaply as possible for the government, and so that's why you've seen that the rate has always been managed. They try to see how they can borrow, make the rates as moderate as possible, so that they don't borrow high cost of borrowing for the government. So I believe that for now, with the inflation staring us in the face, 20% staring us in the face, and then the fact that the government need to borrow to fund the activities of their own activities, especially with the election coming in, especially with some infrastructural development that the government need to embark on, they will really have to come into the local market to borrow heavily, and when that happens, you see this yield continue to go up.
Yeah, but Chika, what finally needs to happen for us to get those FPIs back into the market? Confidence.
The government has to show the capacity that they will be able to, because the major concern actually is the ability to pull out. Now, with what is happening with the airlines, that will definitely affect any prospective FDI to come in. And so the government has to show the capacity that they are willing to, to get people, they're willing to provide FX when these FBIs are ready to pull out. And another thing again is, pre-election year, we all know what happens in third world countries or developing economy like Nigeria. So, there's always this flight for safety till after the election. And so, between now and end of the election, we will see a situation where there will be next to non-existence of FDI coming because of political risk, and then, of course, the uncertainty as regard the election. And so, in as much as all these factors will play a major role, government will also have to keep doing their best, to keep ensuring the foreign investors that they are willing to create the enabling environment, and they are willing to provide FS when they want to exit.